let's get into a very important concept that you need to understand if you're going to be a profitable trader. When I started to understand market structure, I'm telling you, my trading went to a new level. I started to win a lot more, and it's just crucial to be on the right side of the market. And sometimes what you're seeing is not what's actually happening, meaning that you're seeing a small picture and not the big picture. And when you're looking at the small picture and you make a move based off of that, the big picture will soon reveal itself, and you'll soon be in the red because of it, because you didn't really know what was going on from a larger point of view. All right, so market structure and understanding that will help you stay on the right side of the market, and you'll be able to identify what's going on more often than not. All right, so let's jump right into this. So we have a bullish example, and we have a bearish example. And we all know bullish is when the price action is heading to the upside. Bearish is the opposite, when price action is headed to the downside. But you know that by now. You've been paying attention in the course. You've been taking notes, so you already got that down packed. Okay, let's jump into market structure. Okay, so right now, we'll start here. Now, we had a low. So we're starting from a low and we're going up to a high. All right, so we're gonna mark these points here. Let's take this tool and we're gonna go from our high all the way over, and we're gonna go from our low and we're gonna go all the way over. So this is an external low and external high, these two lines. So now what happens next? Price action starts to go to the downside. So we have a low, a lower high, a lower low, a lower high, and a lower low. So at this point, when I say the small picture, I'm talking about this. There are some traders who may feel like, well, hey, we're bearish now. Price is going down. I'm going to start buying puts here and here and here because we're going to the downside. I'm going to buy puts here as well. Well, look what happened next. Price went back up and it made a higher high. Okay, so we have a higher high, and when this happens, this is called a change of character. A change of character. Okay, let's type that here. Change of character. All right, I don't want it to be that. Okay, so this is a change of character. When we're going to the downside, and then we pull back up and we make a higher high, that's a change of character, because this point is higher than the previous point. And then we went down here to this point, and then we shot back up through our external high. All right, so when this happens, when we break through our external high, then we are looking to go long. We're looking to buy calls because it broke our external high. But all of this action right here is internal structure. These 2 points are your external structure points. So now we have a bearish example that we're going to go over next, but you have to be aware of this because it can really trick you. And it got me early on when I first started to trade. I didn't understand market structure, and I was the one buying puts in this area, and then boom, price action goes back up and shoots through the roof. And now I'm having to exit my trade at a loss, and I'm wondering what happened. Well, this is what happened. So you have to understand market structure in order to be profitable. So a lot of traders, they'll wait until an external high is broken either to the upside or to the downside, and then they'll take a position. So you can take a position here as long as you understand pullbacks and when to enter a trade. So if this is happening, you never want to buy puts here. You always want to wait for a pullback if you're going to buy puts. And then when you go to the downside, you can close your position, but you don't want to go heavy on puts when you don't know exactly where the direction is headed. It's safer, if you want to buy puts, for example, to wait until this bottom line, the external structure, is broken. When this breaks with volume, then you can start to take puts because it's a lot safer. Conversely, if you want to buy calls, you want to wait until this external structure, the top line, is broken. Then you can take your calls. It's a lot safer to do it that way. And now, this is another point that we have to make. When the price action breaks through this upper line of the external structure, you also have a new low. That new low is the lowest point of the internal structure. And that is this point here. This is all internal structure. So when price action breaks to the upside, you want to move this line here. Let's go here. Because now this is your new low, and when price action goes up here, this becomes your new high. So this is called your trading range. Your trading range has now changed. So we always want to make sure we mark and move our trading range as you examine your chart. This will change, and when new highs are made and when new lows are made. So let's take it back. This originally was your low. This originally was your high. The lowest point of the internal structure, this is the lowest point that caused this break of structure. So the lowest point, not this point, not this point, not this point. Some people will make the mistake of making this point the new low, but it's not at all. It's the lowest point of the internal structure that's your new low. All right. So again, briefly, I'll go back over it. We head to the downside, and then we have a change of character because this point is higher than this point. When this change of character happens, your antennas should go up and say, "Hey, we're no longer bullish. We're no longer bearish. We're bullish. We're still bullish," because here it appeared that we were bearish, but in actuality, we weren't. It was just a pullback in order to continue to go bullish and continue the move to the upside. So when this happens, this point, when you see a higher point that's higher than the previous point, that's a change of character in this bullish example. We pull back and then price shoots up. And when it shoots up, we move our high, our trading range goes higher, a higher high. And then we use the lowest point of the internal structure as our new low. And then we look for the same thing to happen. Price comes down, maybe it goes up, maybe it goes down, up, and then maybe it goes to the downside. All right, so let's go over to our bearish example. Same deal. We have our high and we have our low. Okay, so price was up, then it went down. high, our low. So then price went back up, down a bit, back up, back down, then back up. So the same thing. A lot of traders feel like, well, hey, we were bullish, we were going down in price, but now we're headed to the upside. So it's time to buy calls. So they're buying calls here, 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 because it appears that we're headed to the upside. But in actuality, we're not, because what happens next? Price, so we have a higher high, higher low, higher high, higher low, higher high. But then the next thing that happens is this. Change of character. Because this change of character is because of what? It's lower than the previous point from here to here. So now this is a change of character. Right here is our change of character. Price pulls back up, back down, back up, and then shoots to the bottom. Okay? And when that happens, we have a new low. And where is our new high? If you said here, you're wrong. But if you said here, you would be correct, because this is the highest point of this internal structure. So we will move this here. And this is our new high, and this is our new low. This highest point in the internal structure created this new low. So this is our new trading range in this bearish example. Okay, so change of character and when you have a break of structure. We had our line here. Let me just go back here for you. Move this line back over here, because this can be confusing to understand initially, but it's very simple once you get the hang of it. Again, when this happens, this is called our break of structure. Let me just type that up for you too, just to have it on. And we have break of structure. Okay. When this happens, this is a break of structure. Break of external structure. This is change of character. Price action is going to the downside. Then we have our first point that's higher than the previous point. This indicates that we are still bullish. We were bullish here because price is going up. But then the market will trick you to make you think that, well, no, we're not bullish anymore. We're bearish. We're going to the downside. It's time to buy puts. No, it's not. Because this happens. This change of character happened. A higher high, higher low, and then this happened, which was a break of structure. When the structure breaks, then at that point, price action will more than likely continue to the upside. All right, let's go back over here. We have our high. I just want to go back over it just to make it clear, because like I said, it can be something that you have to just make sure you have to continue to review to understand this and to be able to identify it on the chart. And we're going to go there next to the charts. So here, this was our break of structure, break of external structure. Again, this is all internal structure. This is all internal structure. But when we came up, down, and up, once this happened, we had a change of character, because this point is lower than this point. Change of character. Back to the upside, back down, back up, and then it shoots to the downside. Okay, so a lot of people, when this happens, let's say here, when we had the change of character, this point was higher than this point, a lot of people will wait for a pullback, and then they'll enter for calls if they don't want to wait for the break of structure. Now, waiting for the break of structure is going to be the safest play, but when this change of character happens, you can assume that price is going to head to the upside, but you always want to wait for a pullback, and you always want to make sure you have a very tight stop loss that's just beneath this point here. All right, you don't ever want to lose more than, let's say, 10% of what you put into the investment. If you put in a trade for calls and you spent $1,000, 10% is $100. Okay, you don't, or maybe you say 10 to 15%. So you don't want to lose more than $100 or $150. Okay, so you want to set the tight stop loss just in case, but we can assume the price will head to the upside. All right, and this example, same thing. When people want to get in for puts, once this change of character happened right here, they would get in for puts either here or here, but you always want to wait for a pullback, and again, a tight stop loss. All right, but the safest play is going to be when the external structure lines are broken. So now we're going to go to the chart and see an example. Okay, now let's get into an example with market structure using the chart. So right up here, we have our high. Let's take that line tool and go straight across. Just like that. So price action came down from that high, went back up a little bit, back down, up, and then down to form a new low. Take that line tool and we'll go straight across here. All right, so as we talked about, we have what is called external market structure and internal market structure. These two lines represent our external market structure, our high and our low. Everything inside of this trading range is our internal market structure. So, internal market structure, everything inside, and then external market structure, represented by these two lines. Now, so we came down to a low, we made newer highs and newer lows. So higher highs and higher lows. Higher high, higher low, higher high. We have higher highs, higher lows, and we push to the upside with volume. Then we get up here and we break this upper external market structure level. So let's take this up here and we break right here. We had a candle close above this line, and then another candle that closed above it as well. So that's confirmed, a break of structure. Okay, now before we get our new high, we want to see one thing that's important, and we want to see 3 candles close below each other at a high. So we have 1 candle here, 2 and 3 red candles close below each other, and we have the high here. So now we take let's move this to the side. Now we take our line and we move it up, because this is now officially a new high. And let's make this tighter. So now we have a new external market structure level. Okay, now this is still our low, and everything inside is still internal. We go to the right, we come down a bit, up a little bit more, and then we bounce off of this line back to the downside. And we have 1, 2, 3 candles close below each other, even 4 candles. So we take this line now, since price action started to go back up, and also price action went back up and broke our new upper market structure level line, we take our lower level, and now this becomes our new external lower market structure level, and this is our external, let's bring this up here, and this is our external upper market structure level. So as you can see, now we have this trading range, and it's a smaller trading range. So you can go from a larger trading range to a smaller trading range and vice versa. There's no problem with that. All right, so we'll move forward to the front. Okay, so if we do this, now we have a break of structure here. Let's move this up. Let's get rid of this here. Let's get rid of that. All right, so we got the break of structure right here. We push to the upside. So we go up, we have 2 candles, we don't have 3. We have 1 candle, we have another candle here. But when we get up here to the top, we have 1 candle. Now they don't have to be in a row. So we have a red candle here, a green candle here, but this red candle closes below this red candle. This one closes below this red candle. Now we have a legitimate new high. Let's move this line up. Let's move this up here. Now our upper external market structure level has moved up, and this is still our low for right now. So let's get rid of this break of structure for the moment. Okay. Now everything within this range, within this new trading range, is internal market structure. No high has been broken and no low has been broken. So we are currently still in a trading range right now until a high is broken or a low is broken. So we're still in a range, and we would like to see a break before we take a trade if we want to play it safe. Now, again, like I said before, you can play the internal market structure range, but just know what you're doing. Wait for pullbacks, and like for an example, price came down, it went back to the upside. So we can play the internal market structure, but we like to wait for the breaks of the external market structure. Because, for example, let's zoom out a bit. Take this line all the way across. Just like that. Let's take this line all the way across. Now let's say tomorrow, for example, this price action, where's my line? My line is right here. Okay, so we're right here currently. Let's say price action starts to head to the downside. Down. And right there. At this point, we have a change of character because this point is lower than all of these points here. And some people may say, well, hey, this is support. It technically is somewhat of a support level because we had a few 2 days that this has kind of been support. Now, I say kind of support because if we mark this level, let's just mark this with a line. Oh, no, we don't want that one. Let's mark this with a, where's that tool at? A horizontal line. And let's just make that a little thinner. You know what? It's not really strong support. Why? Because look what happened here. Price action just flew through the level like it was no problem. Went back to the upside, flew through this level like it was no problem. Then it came back down, went sideways a bit, came back down, up, down, up, down, up, down. So to an extent, it's holding. But when I see things like this, it's telling me that the price action isn't really respecting this level. So soon, we're going to either break to the upside or break to the downside. And in this example here, let's say price action comes down, creates a what? Change of character. If you said change of character, you are definitely on point of character. Okay, change of character. So we can assume that price action is going to continue to head to the downside. All right. And there is likely that we have something called liquidity. And we're going to talk more about that. But there's liquidity here and here. So I would expect price action to come take out these lows. This is a low and this is a low. So I'm expecting price action to come down and take out this low and then come down further to take out this low. And after it does that, I would not be surprised if price action went back to the upside. And why do I say that? This wouldn't surprise me one bit if that happened. Now, I say that because of this. What was price action doing previously? It was bullish. Look at this run up from here all the way up here, a pullback all the way up here. So price action was bullish. Now we're just headed sideways, not really up or down. We had a slight pull down here, but not significant. So we had a lot of sideways movement, but previously we were very bullish. So price usually will come down and take liquidity, and liquidity basically, let me just type that up here, but again, we're gonna go more into it. There are a lot of orders down here waiting. In this area, if we draw a, where is it? We'll use this right here. So we have a lot of liquidity below this low, and also, so this entire area is liquidity for the market to come and grab before it continues its push to the upside. There are a lot of buy orders down here, a lot of people waiting to buy. So it'll come, grab these buy orders, and then head back to the upside. All right, so let me get rid of that mess. So everybody, market structure and understanding it is super, super important. In our previous example, we talked about if the price action were to do this. Head to the downside to take out this low and this low. Now, we are in the next day right now. In pre-market, look at what's going on. Price did not decide to go to the downside to take liquidity. It's continuing to the upside. So at this point, let's just type this in. Okay, change that color. So we have liquidity down here at the bottom, but we also have liquidity. Oh, take that down. We also have liquidity above this high right here. So we can assume, since price action is headed to the upside, that we're coming to grab and push into this liquidity. All right, right above this high. There are also orders above that high, below this low. But we're headed to the upside right now, and this is pre-market. So at this point, if we look down here at the bottom, it says Wednesday, February 7th, 2024. Okay, that's today. If we take the crosshairs and go to the left more, we'll see that Wednesday changes to Tuesday right here. Okay, so pre-market right now, it is 8:30 a.m. Eastern Standard Time. The market opens at 9:30 a.m. Eastern Standard Time. So we have an hour left before market opens. So we don't know exactly where SPY is going to open, but what we do, we can erase that because price action is remaining bullish, but instead of heading to the downside and going back up, it's going back up from this level here. So if let's just say we want to enter this trade today, and I'm going to be looking at SPY today for sure. But before I buy calls to make money as the stock increases, I'm going to take, because right now, well, let me just draw the Fibonacci. I'm going to take our Fibonacci tool and this previous low right here, I'm going to take it all the way up. Now, what you want to do is you want to wait until the price action starts to pull back. So right now, we're still inching up more and more. But as soon as price action pulls back, we want, all right, so you see what's going on here, it's pushing up. So we want to see at what point does it stop going up and then start to go down. When it heads to the downside, we don't want to take an entry until it gets into this 0.5 zone or anywhere to this 0.786 zone. Anywhere in between is a discount. So we want to buy discount. So when price action comes down, we want to buy anywhere in this zone. And at this point, I would buy calls because there's a great chance that price will continue to go to the upside and push through this high, this external market structure high, into this liquidity. And we can see that we're very close to the 500 level right here. So it's a very good chance. We're $5 away from that. It's a very good chance over the next couple of days we end up at this level. All of this liquidity up here above this high, all of these orders. So the banks and the institutions, they push prices in the direction of liquidity. That's a concept that you want to be aware of. All right. So a small example of this are just the wicks you see at lows and highs. You see this low here? You see the base of this red candle? What happened? You saw a wick. This was a liquidity grab, just to grab some liquidity before heading to the upside. So if you had your stop loss, let's say right here, it hit your stop loss, so you got taken out of your play. It went down just a tad bit more and then headed to the upside. So there are people who place orders for calls right here, but they had the stop loss right here. And then what happened? Their stop losses got hit. They got taken out of their order just for price action to continue in their favor, since they bought calls because price action went back up. So it's just something to be aware of when you're at lows and at highs. Okay, same thing happened here. Price action came down. We had a base here, the bottom of this red candle. And what happened? We had a wick. So price action dipped down and then headed back to the upside. These are all liquidity grabs, and they are done by the institutions and the large banks. All right, they they can pretty much assume where your stop loss is going to be. And at times, the price action will come hit your stop loss, will then continue to head in the direction that you want it to go. So liquidity is just something to be aware of, especially at highs and lows. And like I said, right now, we can see with this volume here, that price action is going to push through this high. And I'm not sure if it's going to do this before the market opens. However, if it does not, I'm just going to wait for a pullback today, take my entries in this zone, and then ride the wave up. But it looks like we could break before the market opens. Regardless, we'll just keep raising our Fibonacci tool until the price action starts to head back down. But we will not buy high. Do not buy high. Don't ever do that. If the market opens right now, let's say, and right here it opens, you do not want to buy calls up here at all. All right, so just want to make that clear and go into liquidity and give you an update on what happened based off of that previous example, and the next day what you see going on. And there's a big push there, so it's coming very close to this. Now you may say, well, hey, could this be resistance? Could it reject off of this level and head back down? That's possible too. It could come up here, it could grab some liquidity with a wick, and then come back down. So we don't know what's going to happen. All we can do is be patient. That's why in the first module, the very first slide, the number one thing on that slide was patience. The number two thing on that slide was discipline, because we have to be willing to sit back and wait for the market to show its hand, and then we take our position.